Hi everyone and a very warm welcome to the next episode. I hope you're staying well as the number of cases are spiraling up. We have realized over the past few months that timing of the markets is the most futile exercise. We have seen the markets falling from 12,000 to 7,500 and reclaiming 11,000 odd levels as we speak. We have also seen casualties along the fixed income wave. To discuss both these variants and discuss a subcategory of equities which is best left to the discretion of fund managers where they dynamically manage both the equities and fixed income component, we have the team of Kotak Mutual Fund, Mr. Harish Krishnan and Mr. Abhishek Bisen to discuss the concepts of a balanced advantage fund. Many thanks, Harish and Abhishek, for joining in. And I hope both of you are doing well, and so are your families. Both Harish and Abhishek have about 15 years of experience in the field of fund management and equity research and have been associated with Kotak for a long time. They manage roughly about seven funds each at Kotak Mutual Fund. Uh, so, Harish, my first question to you is that while we typically talk about 5 to 7 years horizon as far as equity investments are concerned, considering the allocation in a balanced advantage fund, can an investor or a first time investor wanting to explore the equity route come in with a shorter fund, shorter time horizon as well?
Hi, Megha. Thank you so much for having us today, and trust everybody is safe in these times. So clearly, equity is a volatile animal. There are ups and downs. It's a non-linear asset class. The way I often kind of describe it is, businesses and real world don't work in Excel spreadsheets where you can have one straight line extrapolation and everything falls into place. It's very much like our lives. There are phases when it goes up and there are phases when it goes down. But the point is to remain invested, wherein you get the maximum bang for the buck, so to speak, in an asset class like equities. Now, with respect to your question as to what is the time horizon, as to why we suggest longer time horizons, I think clearly we have seen that when we increase our time horizons greater than 5 years, 7 years, 9 years, or maybe even beyond, the chances of an investor making returns higher than that of, say, a fixed deposit or any other alternate investment, which typically is the benchmark for most investors and savers, moves up dramatically. So much so that we can almost see over the course of the last 25, 30 years of trading history that we have in India, that we almost have 100% probability of an investor making higher returns as this time horizon goes up. Now, does it mean that everybody needs to have a 15, 20-year horizon? Yes, it will be lovely if all of us can do that, but I'm sure goals don't wait for 15, 20 years. We all have different kind of aspirations and goals. And it is in that context that we have kind of designed the Kotak Balance Advantage Fund. So the broad contours of Kotak Balance Advantage Fund, if I were to say, is twofold. First is I would say that most investors, as I said, look at a fixed deposit, say an SBI or a nationalized bank fixed deposit as the gold standard for their alternate. That's the hurdle rate, so to speak. So we said, can we have a product where on a rolling 5-year basis, that is, if you invest today, say exactly how you would look at FD only at the time of maturity and or expiry of the product, and then you decide whether to roll over or look at other avenues. Can we have a product that gives the comfort that we get at least returns similar to that? Okay. So on the other hand, especially in today's low FD rates, it might take anywhere between, say, 16 to 18 years to double the money. Now, that's a long time for our goals and aspirations to wait. What we've seen is by linking a product into equities and dynamically managing it, we've seen that over the course of the last 20, 25 years, we typically see a doubling anywhere between, say, 5 to 8 years. So let's say even 8 to 10 years. So that is the value proposition. A downside similar to that of FDs, and an upside is a faster wealth creation so that it is more in sync with your goals. And that is the premise of Kotak Balance Advantage Fund. And it is in that context that we think that one should have at least a 5-year kind of a horizon while entering a product like a Kotak Balance Advantage Fund.
I think that's a fair, point that, an investor should come with a 5-year horizon if there is an equity exposure. That brings me to my second question, Harish, which is, you have successfully been, going underweight and overweight on equities as we see over the last 4 months. In March, you went as high as upwards of 75%, and you're down to roughly about 65% today. So, for the benefit of our investors, could you explain what are the factors which you consider while making your decisions about what percentage constitutes the equity in Kotak Balance Advantage Fund?
Right. At the end of the day, all of us, professionals like ourselves, advisors like yourself, or even the investors or your clients, all of us have our biases, and I don't think we can wish it away as much as we want to be objective and dispassionate about our decision making, right? And the two common biases are greed and fear, right? So when things are good, we can all think only the good things. We'll have WhatsApp messages which amplify the good things. And when things are bad, we'll have the complete reverse. And this essentially is the bane of all investment decision making as far as asset allocation is concerned, which is why we're very clear that the role of the asset allocation is best left to a model which takes that decision so that these biases can be minimized. Now let's see what the model looks at. If I were to give an analogy, today, for example, most of us, prefer the comfort of an automatic car as against a manual car. Of course, in COVID, where are we going to drive? But let's assume that, we get out of this sooner. If you really look at the way an automatic car works, there are broadly two input variables. I'm just kind of oversimplifying it. I'm sure the engineers have a lot more variables to consider. First is, what is the speed with which the driver wants to kind of move the vehicle, right? And the second is, what is the feedback that the vehicle is getting? Is it going up a slope, going down a slope? And basis that, the gears change automatically, right? In a rough sense. In the same format, we look at two factors. The first factor is, what is the valuation at any point of time? This is determined by a trailing price to earnings, which is, very objective kind of thing. Every day it comes out, every day we put it. The second is more the feedback of the market, which is the sentiment gauge. Now, there are a whole bunch of 3 or 4 different variables that we look at it. We combine both of these, the valuation aspect and the sentiment aspect. We then put them in the model, and on a daily basis, we therefore decide what should be the level of equity that needs to be there to try and balance two things. A, there is a risk of participating in equities, but B, there is a bigger risk of not participating in equities and missing out. I think that is the thing that we constantly keep missing out, especially in a down market. We are so obsessed with, how fast we are going down that we actually kind of miss out that opportunity cost of what we are losing if we don't. So the idea is to balance both of these, and which is what the model tries to do, using both of these factors to arrive at some kind of an optimal zone where investors can have the benefit of both some kind of a downside protection as well as an ability to participate in markets.
Great, Harish. I think, since most of our investors would be Bangalore based and they cannot appreciate automatic cars, less, I think it's a great analogy. That brings me to my third question to you, which is, if I see balance advantage as a category, different fund houses, if I were to talk about the leading ones like yourself, ICICI, HDFC, Nippon, etc., they have different philosophies in which they shift the gears of equities is concerned. Now, if you look at HDFC, they follow a static model. However, if you look at Nippon, they kind of do the equity rebalancing on a monthly basis. However, you and the flagship ICICI fund in this category rebalances equity on a daily basis. Now, what are the pros and cons of each, and how should an investor understand which is best suited for him? And does this daily rebalancing kind of increases the turnover ratios for your funds in general?
I think it's a great question, and I'll bring back the traffic concerns of the typical Bangaloreite as he or she navigates through Bangalore, right? Essentially, why do we need the flexibility of daily rebalancing? The matter of fact is that, like I said, equities are non-linear. Volatility, we all know, is a function. It's a part and parcel of equity markets, but it doesn't come pre-announced. It does. You never know that what is the cause of the volatility. Once it is over, we can all put a label that this happened due to COVID. This happened. So similar to that, a traffic jam in Bangalore can be caused by God knows a billion or gazillion factors, right? And to have that daily flexibility, which means depending on the market feedback and the valuations, to have that flexibility to change the gears, I think is a massive kind of benefit that we think our kind of model or our kind of philosophy works through. Now, your point is right. What is the negatives? Let me speak about the negatives of a daily rebalancing. One is, are we changing the gears too much or too often? Which either damages the engine, which is or counterproductive. The second is, um, um, you know, even if let's say that our optimal zone has to be in third gear, we can still go in with second gear. Do we really need to be sure that we need to go to the third gear? So there may be some cost involved, like you said, which is the turnover or the trading cost, etc. Right? So let's try and take both of these together. First is, see, a typical year, if you look at it, has about 250 trading days, right? Now, while we rebalance or we run the model on a daily basis, what we've seen is that there are about anywhere between, say, 25 to 35 odd days where the model changes, uh, suggesting that something has changed. Either the feedback from the market or the valuations ranges have moved, right? Um, like I said, that flexibility that those 25, 30 days, and you brought in that point of how we moved in March, for example, right? So just to try and illustrate, in March, in 5 trading days, we saw markets fall from 9,000 levels Nifty to 7,500 levels Nifty. Now, if we were doing a monthly rebalance, and that happened from March 17 to March 23rd, yeah, and by the end of the March, we are back to 9,500 levels. That entire move of 9,000 to 7,500 back to say 9,000, effectively you've kind of missed that opportunity. Of course, it's only in hindsight that we know it's an opportunity. I'm not saying at that point of time we knew that 7,500 was the absolute bottom. Absolutely not. This model is not a predictive kind of a model, right? So therefore, the idea is you need to have the benefit or the agility of taking care of these opportunities, because like I said, they come far and few. In a year, we will have maybe one or two such instances where we can dramatically increase asset allocation. And at that point of time, if our hands are tied and saying that we'll do either on expiry or on monthly or on 3 months, etc., chances are that you might kind of miss out. The second is, are we bringing too much noise into the equation, because that's the thing that you don't want to constantly keep moving up and down, and therefore does it add to the turnover or the trading cost. So what we tend to do is that for small changes in equity suggestions by the model, we don't move the entire portfolio. We do it either through Nifty or Bank Nifty, which is one single instrument. You can be +3, -3, etc., wherein there are no costs. The costs are maybe 1 or 2 basis points as an institutional investor that we get. So there is no major cost involved to that. But the benefit that it gets is that you get that agility that I spoke about, right? So therefore, if you balance both of them, we think that this is a great feature that we think it brings in. The second and a kind of a related thing is that let's assume that this was not an automatic allocator in itself, right? And by pure, I'm taking the same case as in March. Let's assume that an investor woke up on March 17. He saw the carnage from 17 to 23rd, and he said, "Yeah, this is the time that we buy in." He sells out his debt or his cash investments. It takes 2 or 3 days to come back, right? And then he invests into equity. By the time the fund manager or whoever invests is again 4 days. Now, those 4 days are very expensive if you miss out on such opportunities in markets. So we're trying to optimize. That's the right word. There isn't a ideal situation. I'm sure the other fund houses have their explanations, but we think that the benefit of agility is what we get when we do on a daily basis without too much of cost, like I explained, wherein we do it through Nifty and Bank Nifty, where the costs are very marginal.
I think that was very well explained, Harish, and I think it gets the point very loud and clear that you make returns not on 250 trading sessions, but maybe just on 5 or 10 days as far as the year is concerned. My next question is to Abhishek to touch upon the fixed income component as far as Balance Advantage Fund is concerned. Abhishek, while I look at your portfolio, I see a completely AAA rated portfolio as far as the fixed income part is concerned. In today's times, it gives us a lot of comfort, both to us and to our investors, when we see a completely AAA rated portfolio. However, I would like to understand from you that is it a tactical, call that you have taken considering the situation we are in, or is it the broader philosophy or mandate of the fund? Because, and do you feel that probably not running an accrual can cause some amount of damage as far as returns are concerned to the investors in the long term?
Yeah. Hi. Firstly, thank you, Megha, for giving this opportunity. Well, to begin with, as far as the structural design of this fund is concerned, in terms of credit accrual versus kind of AAA or a duration kind of strategy, we were very clear. If you look at the asset allocation in this particular fund, if this fund can go minimum 20 to 80% on equities in terms of directional equities, and balance is into fixed income strategies. So if you look at inherent risk per se is reasonably high, even if you compare from bottom to high. So if you are going on a higher side on the equity risk, then if you take equivalent amount of risk in terms of fixed income also, it actually kind of doubles the risk profile on one hand. On the other hand, if you look at the incremental return which the debt while adding towards credits is going to generate is, let's say, in terms of basis point, it can be 20, 50 or 100 basis point depending on what you are taking. But if you lose, probably you can shave off 20, 50, whatever, depending on what kind of allocation you've given to credits. So that kind of upside versus downside ratio is there, giving the overall profile of the fund is concerned. So it was a conscious call that we are going to remain in a best quality, and it was a fundamental view as well at that point in time. But we retained flexibility to go up to AA, because at that point in time when we launched this fund, we could not fathom this kind of situation where we can go actually so low in terms of overall interest rate environment, where the overnights will turn to around 3.5%, and the credits will be giving reasonable good credits will be giving 9, 10, 11, 12% also. So because of the illiquidity and uncertainty element coming into play. So there is no as such restriction per se, but we are avoiding at this point in time because uncertainty is an element where, as I said, you are gaining very little, but in case if you lose, there can be a big damage to the overall fund. So therefore, we are managing the risk part on the risky assets itself, and balancing debt is non-risky in terms of AAA or directional duration call is giving decent amount of return. So we are maintaining that strategy at this point in time. So as far as debt, let's say returns are concerned, in terms of YTM or the running yield in the fund is concerned, it is around 6% at this point in time, and the YTM is around 6%, 6.5%. And if you look at the average maturity, it is towards on the higher side. It is around 7 to 8 years with a mix of AAA and sovereign assets. And if it goes down, it can run down to 1 2 year also, depending on what kind of outlook we have on the interest rate on overall basis.
Thank you so much, Abhishek, for explaining why it's better to avoid risk on both the sides of balanced advantage fund. And thank you, Harish, for taking us through equity. Now that we have you, Abhishek, here, we have certain questions about fixed income in general. And to some extent, you answered my first question in some part in the answer which you gave last. So my question is for a risk-averse investor who is generally considering or who generally considers fixed income for maybe, generating 1 to 2% incremental return over and above the fixed deposit. Now, for an investor like that who's predominantly risk averse, does it make sense for him or her to look at only AAA, PSU, or sovereign papers at this point of time, or there is a merit in looking at AA plus rated reasonably good credit quality papers also? And since you mentioned it in the last answer that there are some decent companies available which are offering good yields, so if you could please enlighten us on what should be the strategy for a risk averse investor.
Yeah. So for a risk-averse investor, there are two broad kind of risks which we understand at this point in time in terms of investing is concerned. One is clearly the credit risk as we discussed, and the other is the volatility or the maturity risk, right? So
Right.
if you look at any investors who is looking to invest, firstly and foremost has to very clearly spell out what kind of investment horizon he has.
Right.
So that is one very clear understanding you should have, because there are times when people have 1 year investment horizon, but because of the return, past returns or the view, etc., whatever it may be, but they are investing into 10-year and 15-year and 20-year kind of maturity assets. So there is a possibility that the view goes correct and you are making a good amount of returns. But in case something goes wrong, your returns actually get pushed towards second, third, and fourth year, where you cannot take your investment to that kind of level in terms of flexibility. So, assuming the investor, whosoever is looking, is a risk-averse investor and is looking to invest, say around 3 years. So 3 years is a fairly good amount of time, and we have seen good amount of cycles also in 3 years. Those cycles used to be 5 and 8 years, have turned around twice in 3 years. So that kind of shortened interest rate cycles have become. So that brings me to a level where you need to keeping the interest rate or the investment horizon constant, whether one should go towards credit or whether one should go towards a AAA or PSU at this point in time. So why we are saying the AAA or PSU at this point in time? Because till January, February, things were completely different. We were in a normal economic cycle. Now we have suddenly gone into a cycle where the economy itself is in a trouble. There's a deep stress in the economy, and we are into an uncertain where, let's say, when things settle down, what kind of business environment will survive and what kind of business environment will emerge, we don't know. So it's a completely a black box how things are going to be, and when they are going to be, both are a big question mark at this point in time. So in general, what is the investor behavior in general? 9 on 10 investors are looking towards safety of the principal first. They don't mind whatever returns are coming, we don't want, but my principal should be absolutely safe. That is point number one. Point number two, then what kind of returns I can generate? You can say any 5, 6%, 7%, they are fine, but my principal should be 100% safe, but then whatever returns I'm able to generate is fine with me, and this is my investment horizon. So these three things are calling the shots as far as how the interest rates are moving and where are they moving at this point in time. So clearly we should be with principal safety, and whatever returns are being able to generate in a 3 to 5 year bucket, which is around 5 to 6%, or depending if you can elongate it, it's between 6 to 7%. And as far as some amount of it is concerned, since you are looking into the fund, so funds are dynamically managed, as I said, as and when the themes are slightly coming to an end where we believe the rate cycles have now somewhat bottomed out and probably economy is looking to revive from where some more clarity is available. That point in time, automatically in the dynamism, probably some funds will shift towards some AA plus spread assets where you are incrementally able to generate these kind of returns. Otherwise, at the space of it, good marquee names like Tata Birla, they are offering reasonable amount of returns in terms of, you look at their normal debt or their perpetual debt, they are offering good amount of returns. They are good pedigree, good balance sheet, sound balance sheet at this point in time. PSU banks, they are offering decent amount of returns. Some are 9 to 10% also. So returns are fairly good, but at the same time, the liquidity and the volatility attached is reasonably high. So one should look towards that also while investing into these strategies.
Thank you, Abhishek, for a very, very detailed answer. In fact, this answer is related to my subsequent question. So I'll go step by step. So generally, what we believe in, that it's very difficult to predict the movement of the rate curve, and it's advisable to match the maturity of the underlying instrument with the time horizon or holding period or proposed holding period of an investor. And we generally try to match these two. And in fact, you touched upon that also. Now, in these times, is there a merit for an investor to look at some tactical call as far as going a little overboard in terms of duration, or going a little conservative on duration? Does it make sense, or we should go by the tried and tested principles of time horizon and underlying maturity matching each other?
One twist to that equation, you can choose any fund at this point in time you like, depending on the credit and duration appetite. Whatever is the asset profile, let's say the asset profile is 5 years. So a 3-year investment horizon can take up to 5-year volatility. That principle you can apply. Or in fact, a 10-year cycle also in 3 years is able to give fair amount of, if the view is right on the interest rate, then you should be home in that point in time. The problem which has happened in history is people have taken with a 3-year investment horizon also a fund which is having a 10-year kind of maturity. But in the first year itself, the rates have gone 100 basis points higher, and the first year was zero. But we have observed in the second, third year, the return was so decent that they have been able to take care of the first year loss. There's one misconception which I just wanted to clarify is, unless and until there is an impairment of asset, which means there is a permanent loss, these volatilities are just pushing your returns towards a far end. In case if the maturity, that's a 5-year, so your first year return is moved towards second, third, fourth, and fifth year. That's it. So you need not get overtly concerned of whether I'm permanently losing this money or not. You are not permanently losing. Only your first year return is shifted to second, third, and fourth year. Now, the way we are moving ahead, this is a very important thing to understand. This is probably, at least to my memory, I'm in the market 20 years. Fixed income market is also quite recent in the Indian history. We moved from physical to demat in last 20 years. So that is how recent we are in development of fixed income markets. GDP has never degrown in this era. It can be what I'm told is first time it was somewhere around 1990. So we are talking about somewhere around -5 to -10% kind of degrowth. So what does it mean? The economy itself is not able to generate any returns, positive returns. Forget positive. You are somewhere around neutral to negative in overall economy basis. That means good amount of losses are there. Economic activity is very, 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 very low. So people will be shifting. Those who have money, they don't have visibility. They'll be putting their money towards these assets. And those who are saving, their discretionary spends have gone down significantly because a lot of things have gone off your shelf. Therefore, your money is available to be invested, and these money will be chasing assets 3, 4, 5 years, and so on and so forth. So if you look at the yield curve, if you put your money towards the shorter end, which is 1 to 3 year, your reward is very, very low. It's like this. So if you put at the shorter end, your reward is low. If you put at the longer end, your reward is fairly high. And this things will be chased going forward. The incremental chase will keep on increasing. So which will probably bring this yield curve flattening basis a little bit, or it will remain there only because money will keep on moving from short to long, short to long, short to long, till the time economic revival happens, and till the time we see economy chasing, basically demand for money increasing for business is the net word on that. So till the time that activity actually increases to a level where the money starts generating in the business much more returns than the returns in the markets, till that time fixed income is likely to remain here or probably go down. And we have to see at the same time how the real inflation is also behaving. So these two key factors will determine that.
So if I look at last 2.5 years, every advisor, every investor has been looking, all kinds of credits through a microscope. If I go for a time period before that, it was, duration which was impacting investors in a negative way. Now we are in a situation where both duration as well as credit could go against the investor. And the reason why I'm saying you this is because you mentioned that, we are looking at a GDP contraction after multiple decades. And on top of it, the rate curve is so different this time that there is a temptation among investors to look at 6, 7, 8 years papers while their actual time horizon is 2 years or 2.5 years. So do you think a lot of mistakes can happen in next few months by investors, and maybe they can go right on credit but they would go wrong on duration, or they can go right on duration but they can go vice versa on credit. So how do you handle this situation?
We do a simple mathematics as far as the situation is concerned. Since the curve has adjusted to such a level, let's say you remain simply quite averse to whatever is happening and you stick to the shorter end. So the kind of premium which the market is demanding is fairly high. That is point number one. Which means, let's say you decide to remain as short as possible, which will yield you around 3.5% to 4%. If you are in a fund, you will have tax implication. If you are in FD, etc., you have. So I'm not talking about tax perspective. So let's say you assume 3.5%, 4%. You are likely to generate from that money. So let's keep that math. If you keep generating this 3.5 and the interest rate, because the economic concern remains similar, so 4 into 3, in 3 years you are able to generate 12 rupees. While if you are investing in the 7, 8 or 10 years, 6 3s are 18. So you are able to generate 18 rupees, right? Just the coupon income I'm talking about. Let's say now what happens, your rate call goes wrong and your interest rate rises by 100 basis points. Typically that will take away 6 rupees. Okay.
Right.
So your 18 minus 6 will become 12. So if you go wrong, your as it is generating the same thing which you are able to generate in the shorter end by doing not taking any risk. So here also you're not taking any risk. I am keeping the credit quality absolutely zero tolerance towards credit. I don't want any credit. I want only best PSUs and better quality assets. So my volatility may be there this year, maybe 4%, next year maybe 8%, and so on and so forth. Or this year maybe 12%, next year can be lower, etc. So overall basis, I'm likely to generate 18 to 20% over the next 3 years. So, but the point here is, if the economic cycle remains like this, and there's a possibility that this money will shift towards the longer end, and I may be forced with my future income, with my current investment, which are going to mature, to invest at the longest end at the worst possible time. So this is what the scenario is emerging every day passing by, and this is what probably will lead the future interest rate scenario. What has happened to the developed world? You just look at the rates are zero and negative. So there is no inflation, there is no growth. If the growth cycle prolongs to 2 to 3 years, which the best case being spoken about, next year probably you will see 5%. You will not see growth. You will be actually back to square one. And next to next year you will see 5%. Then probably some growth will happen. So economy in all 3 years will generate 2 to 3%. So if you are able to generate 6 to 7% on a 3 to 4 year basis, it's a fantastic return for anyone who has either capital or savings.
I think it's a very, very valid point, and that also makes imperative for us to, reinforce real returns to the client as and when we meet. And this calculation that you explained, it'll go a long way in terms of educating our investors on how to look at, different durations and how to understand the risk associated with those. So my last question, Abhishek, is about, market in general, and it's more of a macro question. So with Reserve Bank of India having been on a rate cut spree, do you think that the utility of the rate cuts going forward, I mean diminishing marginal utility of the rate cuts going forward, would be very, very low, and we don't see much of an advantage happening if there is a further rate cut which the market is anticipating at this point of time?
Yeah. See, very valid question. As far as the utility is concerned in terms of moving the market, frankly, everyone knows that interest rates alone cannot move the economy. There is a problem with the economy, and there has to be solution which is coming from the economy. Interest rates is just an enabler. It will help you if you are able to fundamentally stand on your own. Basically, when activity starts, then probably interest rates will help you. Otherwise, interest rate alone will not be able to solve all the problems. But having said that, since the activity levels have gone so down that there is no merit to keep rates so high. So in terms of impacting the yield curve, the shorter end of the yield curve may not impact as much as the longer end of the yield curve given the rate cuts. So probably this time around we don't see central bank acting, though there are people talking about it. there is a chance of 25 basis point. It will not impact the shorter end as much, because shorter end 1 to 3 and 3 year, probably 5 year is discounting much more. If you look at the 5 year sovereign, it has reached 480, and the 10 year sovereign is yielding 580. I mean, in the history, it has rarely happened this kind of steepness in the yield curve. So if things happen, then the utility is much more on the longer end rather than the shorter end. But at this point in time, probably central bank will look other measures to overall ease off the longer end of the curve, because longer end still remains there. And if someone wants to really do something on the longer end, the rate still is high, and therefore economic sense doesn't make sense for him, and the credits are getting, see who's acting. Either the government is likely to do any activity, or the corporate. And
Right.
if the corporate is in the SME segment, he is still getting money at 10, 12, 13%, and so on and so forth. So government is getting front end money, which is the near term money, 1 2 year. No one does a business for 1 2 year money. The business is done in 5 to 10 year money only. So the government is expected to get cheaper money for the long term, and the business environment as well. So if you want to really transmit rate towards longer end, so you need to ensure something happens that side. So that is not happening with the rate cuts alone. Central bank are likely to use some unconventional measures, like they may go for HTM hike, or they may go for SLR hike, and so on and so forth. They may do various things which probably will ease off the longer end. So utility, probably with a small amount of tweak in these measures, may have much more on the longer end. Shorter end doesn't have much space. Whatever may be delivered, it will be in and around that. So not the way it has performed so far.
Thank you, Abhishek. And I think you made a very, very valid point that, it's not only the interest rates which are going to decide the course of economy going forward. And I think we are seeing a lot of innovation from central banks, like you explained, and it's become a very, very interesting space for, the students of monetary policy to see all these kind of newer tools coming up. And, for a lot of us who did our post-graduation a decade back, at times it's very, very difficult to understand the concepts on which central banks are working worldwide. So
Yeah.
thank you so much, Abhishek, and thank you so much, Harish. And the kind of examples you gave, be it about automatic car versus manual car, be it about the impact on economy of rates going forward, and how central banks will play out. I think these concepts are going to help our investors and us in terms of having a very high recallability of the discussion which we had today. Thank you so much for taking out time at a very, very short notice, and taking us through different elements of balanced advantage fund, as well as credit market and fixed income market in general. Really appreciate the time and effort put in by you. Hoping that we come out of this COVID mess ASAP, and wishing you, your family, and everyone at Kotak a very safe stay. Thank you so much from our side.